historically strong start to the year, markets have now pulled back to begin the second quarter. Concerns around geopolitical tensions in the Middle East, inflation, corporate earnings, and other issues have led to a market decline, pushing the VIX index of stock market volatility to its highest level in 6 months. In times of market stress, it's important for investors to maintain perspective on the critical issues and not overreact to headlines. Tensions escalated in the Middle East due to an attack by Iran on Israel, the first time a direct strike has occurred between the two nations. The latest developments only add to geopolitical concerns around the world. Russia's invasion of Ukraine and the October 7 attack on Israel by Hamas only a year and a half later have already destabilized Eastern Europe and the Middle East. Without diminishing the tragic loss of life and destruction from these conflicts, investors must weigh how such events might impact the global economy, markets, and their portfolios. Geopolitical headlines can be alarming to investors since they are unlike the typical flow of business and market news. These events are difficult to analyze and their outcomes are challenging to predict since they depend on the actions of individuals and groups with complex histories and motivations. However, history shows that while geopolitics can impact markets, the effects are typically short-lived. The accompanied chart highlights market returns following major geopolitical events this century. Some events, such as 9/11, changed the world order and had long-lasting effects, even though it was primarily the dot-com bust that led to poor market performance. Other events, such as the war in Ukraine, resulted in higher oil prices, which affected inflation and monetary policy. Most of these events did not have long-lasting effects on markets once the situation stabilized. While today's conflicts will be closely watched, investors ought to avoid passing their judgment with their portfolios. In the long run, markets tend to recover and perform well, primarily because business cycles are what matter over the years and decades, despite these events that take place over weeks and months. Second, many measures of inflation have proven to be more stubborn than economists had hoped. The latest Consumer Price Index report for March showed that headline inflation remained hotter than anticipated at 3.5% year over year, while core inflation, which excludes food and energy prices, rose 3.8%. Rising shelter costs, which we define as the cost of renting and owning a home, are a large reason inflation has not cooled as quickly. Combined with stronger than expected recent job market data, many investors now anticipate that the Fed may cut rates more slowly this year, or maybe not at all. The Fed's economic projections have suggested all along that it might cut rates 3 times this year. Market expectations, however, have swung 180 degrees since the start of the year, when some believe that the Fed could begin cutting rates in March or even earlier. Today, markets only expect 2 or 3 rate cuts in 2024. Finally, investors should keep the level of market volatility in perspective as well. While the recent market decline is the largest since the start of the year, this does follow a 10.6% total return in the first quarter. Since last October, when the market began to rally, the S&P 500 has gained over 25%. And since the bear market bottom in 2022, the market has gained over 50%. The accompanying chart shows that the average year experiences significant pullbacks and that this year has been small by comparison. Despite these short-term challenges, markets tend to recover and often end on positive notes. This is why maintaining a diversified portfolio can help minimize short-term risk and increase your odds of financial success over time, regardless of whether markets are volatile due to the economy, the Fed, geopolitics, and other factors. What's the bottom line? Markets have struggled at the start of the second quarter due to changing expectations around the Fed and escalating geopolitical tensions. Staying level-headed and keeping these events in perspective are still the best way to achieve long-term financial goals.